Good morning, ladies and gents, and a warm welcome to October's edition of the 10-Minute Market Forecast. Pleased to have you join us this morning. My name's Jordan, and I'm one of the business managers at Blackfinch, and I'm joined today by product specialist Josh Clayton. Before we get into things, just a quick headline on housekeeping and how we like to run things, either as a refresher, if you've joined us before, or an introduction if this is your first time joining us. With the webinar, our aim is to recap the key events over the past month, highlighting what we believe to be some of the most important headlines across markets, as well as giving you straightforward things to look out for over the next month, preparing you and your clients for the coming weeks. If you'd like to ask Josh any questions, you'll see we've included a handy Q&A box at the bottom of your screen, so please be our guest and type in there, and we'll make sure to come back to you after the session. Otherwise, if there are any other questions after the fact, then I'll make sure to provide you with the team inbox at the end of our session to send any follow-up queries, comments, or feedback onto. So for today, we've got another action-packed month for global markets. This time, eyes have been focused on Asia and what the Chinese government have been doing to attempt to revive that troubled housing and equity market. We also have seen some more central bank activity over the month, interest rate cut expectations moving once again, and of course, the topic on everyone's mind has been the autumn budget, which is due to be delivered by Rachel Reeves at the end of the month. So we'll strap in and let Josh run through things. Josh, good morning.
A very good morning, everyone. And Jordan has absolutely hit the nail on the head. So I think after last week's events, there's no better place than to start in China. And it feels like investors are all of a sudden placing a lot of trust in the Chinese government after recent news. I'm sure, as you know, markets in the past have really shunned China since the property crisis and fears of long-term structural issues with the economy. And investors have been sat on the sidelines waiting for that moment to flood capital back into the market at arguably some very low entry points in terms of valuation. And investors finally got their chance last week. Now, the Chinese Politburo, headed by Xi Jinping, held an unscheduled meeting last Thursday and made an announcement that effectively amplified the monetary policy stimulus announced by the central bank earlier that week. And there was a lot of noise about how things were said, where the word prudence was really emphasized. And this just felt like an adrenaline shot in the arm of the Chinese market and an attempt to put a floor under that troubled housing market. And it's done exactly that. If you look at the CSI 300, which is an index of the biggest mainland A shares traded in China, it rallied circa 25% over 6 trading days. So there are some very happy investors on that front. And it's very significant because it shows China's crucial need to prod its consumers to start buying stuff again. And it certainly feels like the Chinese government's determined not to allow either the housing market or the share prices of many of these companies to fall any further. And it does remove a tail risk from global markets. And that's great because it's really good because it looks like they want to take a punt at reviving this economy. And it bolsters everyone's chance of a soft landing. And then global markets can carry on nice and happy, as we've seen, and for this time around. And it does feel like the Politburo have done a good job of Western-style message management. It's revived Western confidence somewhat, and that's a really big factor due to outflows over recent years. However, the challenges still face the economy over the long term. Chinese markets are still very depressed, and this recent stimulus, as I've said, is a shot of adrenaline for the market rather than a long-term cure for the problem. It certainly feels like a faint echo of Japan in the 1980s or a Japanification 2.0, where there is a balance sheet recession on their hands. And when I say this, think of China's balance sheet, where you have assets on the one hand, liabilities on the other, and a big asset bubble forms, and then once it pops, your assets will fall in valuation quite sharply, but then on the other hand, your liabilities are still there. And this is what's happening at China at the moment, which is plummeting sentiment and leaving very leveraged businesses and consumers with this burden, this worry. We've heard rhetoric that this debt-fueled asset bubble is really evident. If you visit the country, there are like hundreds and thousands of houses left unfinished across China, and consumers are being too scared to borrow. And this is why we have these faint echoes of Japan in the 1980s, where something similar happened. But just to summarize, a great step from the Politburo, the right thing to do to bring stimulus in to attempt a revival, and fiscal policies is the best way to get a country out of a balance sheet recession. But this is going to be a long-term structural issue with a lot of underlying pain to come. Now then, so if we move across and go to the US and the Federal Reserve, I'm sure that many of you know that the Fed finally went for it. They lowered interest rates for the first time in 4 years. And the important point here is that it was a big one. It was a 50 basis points decrease rather than the typical 25 we've seen from other developed central banks. Markets were pricing in about a 50-50 chance of it happening. Step away from the trading floor, and actually it was a big shock for economists. Not that many people predicted a cut of that size. Fed Chair Jerome Powell was asked if it was a mistake to not cut in the last July meeting, and he admitted the Fed probably would have done it if he had access to the June inflation numbers, which were published shortly afterwards. So in other words, it was almost seen as a bit of a catch-up cut rather than foreshadowing what's to come. And just to finish off on that, on the rate cut and dig into it a little bit, if we look back at history, big cuts generally happen in times of economic stress. Think of the global financial crisis in the noughties as an example. But today's terms, financial conditions are very much fairer. We don't see this significant stress globally like we did with the GFC, with a lot of debt-burdened companies. And our view is that this cut at the moment was a cut that was focused on setting the record straight rather than any material fear on financial conditions for the US. But it does reconfirm our view that the real risk for investors has moved away from inflation to recession. Investors are wanting to know what the Fed knows so they can anticipate the trajectory of the economy. So going forward, these economic data points that we're touching on each month are becoming even more crucial. But although the focus has been CPI in the past, it's going to be more important to monitor employment data and economic growth at this stage. And we still expect to see some market sensitivity around these data points going forward in terms of CPI. But importantly, it's that jobs data. Think back to August, the start of August, that triggered a sell-off, as well as the start of September. To touch on inflation very quickly, in the US, it was good news, bad news for the US. The good news is inflation's going down. It's continued the path towards the Fed's 2% target. It's moved from the previous month's 2.9% down to 2.5% in September, and all of that is a tick in the boxes in line with forecasts. However, the bad news is, strip out the traditionally volatile items like your food and energy, inflation went up thanks to housing and travel. So looking at it from that angle, and I'm talking about core CPI here, there are things are looking a little bit more, a little worse for American consumers. And it's important because these are the driving force of US economic growth. It's consumers. So their financial health matters. The fear when the Fed started hiking rates is it was just going to pile onto consumers, especially those that were the more harshly hit by the pandemic. And then the cost of credit card usage would go up and could spark a recession. We've seen it somewhat. I think there was a survey in Q2 completed that showed there was an extra $36 billion in dollars that increased in debt. So yes, it's going up, but to this day, the recession isn't here. Those stimulus checks that were given by the US government, as well as some good, robust wage growth, has kept consumers purchasing. Everything's been ticking over in the US economy. Growth is in expansionary territory. But by no means, it's an important factor the Fed need to monitor. The lowering of interest rates can unwind this, of course, but there is a delay when implementing monetary policy, so this is going to take time to come through. So to summarize the US, inflation's falling, and interest rate cuts are certainly on the agenda going forward. We just need to be mindful of out-of-character economic data points going forward. And speaking of, a few things to look out for this month. It's a very important week for markets. If you think back to those starts of the last 2 months, we had the sell-off in August and September, and it was all down to US employment. As I've already described, focus is what's happening on that labour market, which can be an indicator to the trajectory of the economy. So there may be some volatility today. We've got the JOLTS report at 3 p.m. for the US. But the important one's Friday, where the non-farm payrolls report and the unemployment rate is released. So now, as I've mentioned, our view is that US economy has largely gone over this speed bump of inflation and economic growth is still strong, but there is, of course, nuance. But forward-looking data points supports interest rate cuts over the coming months. Going ahead, US inflation on the 10th of October, Again, we expect focus to be on jobs rather than inflation, but of course, economic surprise here can always weigh on markets, so do watch out for that. UK inflation is the 16th. It sits at 2.2%. We're likely to see this stay around the same level and not see much movement here. And then finally, as Jordan touched on at the start, I've not covered the UK too much in detail today, but importantly, we have the autumn budget on the 30th of October, which is delivered by Rachel Reeves. This is going to be the first one delivered by the Labour Party in 14 years, and it is causing some stir in UK markets, both with investors as well as underlying companies. Now, this webinar is already kind of going over 9 o'clock. I'm sure it could go another half an hour in terms of the autumn budget, but this is going to be the key event that could be a driver for UK markets over the near term. Firstly, we'll always see volatility due to the uncertainty that political addresses can bring. The most famous one of late is, of course, Liz Truss in 2022 that caused the sell-off. There has been some real sluggishness in the UK markets over recent months. We were in a real period of strong company performance. Think of your small caps over the summer, where interest rates seem to be starting to fall. AIM-listed stocks were starting to rally. But the budget has really depressed sentiment, where businesses want to hold off before committing to further capex. And there's a lot of dry powder on hand with investors, and general liquidity seems to be drying up somewhat as investors don't want to make a move just yet. Now, this is all a balance of probabilities. Nobody really knows for certain what's going to happen and what she's going to say. But either way, this is where the case for a well-diversified investment portfolio really comes in. If you're looking at bonds, they offer great levels of lower correlated returns to equities, something that hasn't been present for years prior. And alternative assets, property is the example, it's really paving the way over recent months for returns. So please reaffirm to your clients that a long-term view is always best when considering politics, as you can kind of help look through the thickets and past all of this political noise and see the long-term investment case. But I'm conscious I've gone over, Jordan, so that's a wrap-up. So back to you.
Josh, thank you very much for that. And thank you, everyone, of course, for joining us. If you've got any further questions, comments, or feedback on the topics we've covered today, or perhaps anything that you didn't hear that you'd like our comment on, then please do be our guest and write to us at the email address strategicteam@blackfinch.com. That's strategicteam@blackfinch.com. So, of course, we'd love to hear from you. And so, what's left for me to do is say, obviously, a big thank you again. We appreciate your time and hope you found today's installment insightful. And we hope, of course, we'll be seeing you all again next month on the 5th of November with next webinar. But otherwise, have a wonderful day. And we'll look forward to speaking with you all again soon. Bye for now.